Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm Senior Manager and Education Coach here at Schwab, and this is Getting Started with Technical Analysis. And sometimes a stock trader just decides, hey, I have a brilliant idea. I'm going to find a stock that's going up. I'm going to buy it. No idea when I'm going to sell it. I'm just going to hang on to it as long as it keeps going up. I'm just going to ride it. As soon as it starts going down, that's when I want to sell it. Well, what I've just described there is a process known as trend trading. And sometimes traders will use their charts to plan and place and execute a trend trade. So today's going to be sort of a beginner's guide to trend trading using stock charts. Should be a really interesting discussion. We'll talk about entries, we'll talk about exits. We're going to illustrate things with a current example trade. But before we get to any of that, though, we first of all say hello to everybody out there in YouTube chat. Great to see Kevin and Laron and Jeremy, Life in the Fast Lane, Tony, Scott, Greg, Alfred. Everybody else, thanks for joining us week after week. We really do appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, if you're just watching the recording of this webcast, that's fabulous. Enjoy the presentation. But be aware that you're invited to join us in a live discussion. This one kicks off 2 o'clock, and it's a Tuesday webcast series. We'd love to have you here joining us in a live stream if you'd like to be here, 2 o'clock Eastern Time. All right, I also want to let you know that my very good friend Barb Armstrong is joining us in the chats with the live stream audience. Barb is another one of our instructors. She brings a wealth of knowledge and experience to this discussion. Barb is going to just help out with any questions that I can't get to, so thanks for being there, Barb. And Barb and I would also like to issue an invitation to everybody, whether watching live or watching on the archive. If you're not following us on X, please do. That's the best place to connect with us in between these live streams. You can find Barb on X at Barb Armstrong CS, and you can find me there at Cameron May CS. So let's get right into this. And of course, when we talk about trading or investing, we need to talk about the risks associated with doing that. So bear these disclosures in mind. They are important. The information here is for general informational purposes only and should not be considered an individualized recommendation or personalized investment advice. Investing involves risks, including loss of principal. Schwab does not recommend the use of technical analysis as a sole means of investment research. Any investment decision you make in your self-directed account is solely your responsibility. And yeah, all investing involves risks, including the risks of loss. So let's, oh, I do notice, yeah, a little bit of buffering, a little bit of sound cutting in and out. That's interesting. We'll keep an eye on that. But let's set an agenda for the day. Now, we're talking about trend trading, so I've already basically described what that is. It's an effort to buy a stock as it's going up, see if it just continues to rise, and if it starts to reverse, make a plan to get right back out or to get out at that point. But we're going to talk about some of the basic elements of trend trading, and I'm going to provide maybe what one might consider to be a 5-step example process for trading a trend using charts, and I'm going to illustrate that using current examples. So let's go right to Thinkorswim. I'm going to be using the Thinkorswim desktop trading software platform to illustrate this concept, and I want to outline 5 potential steps for planning, placing, executing a trend trade. And step number 1, I think it might be obvious, but it is to establish just exactly what is the trend first. Now, typically a trend trader is looking for an upward trend. Sometimes they might look for an emergence from a sideways trend, but generally speaking, we'll be looking for upward mobility to stock price. So that sounds easy. Not always. It's not always quite as straightforward as one might think. There are a couple of different ways that a trader might approach the definition of a trend. So let's use Blackstone here as our examples, trading symbol BX. And the two ways that a trader might use to identify or might employ to identify the trend, number 1 is they might prefer to lean on their own experience, apply their own discretion to a chart and determine the trend that way. Another set of traders, and it seems like the buffering has stopped, Kevin, very good to hear. But another way to potentially identify a trend is to recruit technical indicators. It's actually to automate or make the process as mechanical as possible. Now, I'm not going to attempt to tell our traders here which one, if either one of these is going to be their approach. It's always up to the trader's discretion. But let's talk about that first approach to identifying trend. How do we do this manually? Well, there's a process that might be employed, and it has to do with the fact that stocks and indices might generally, instead of moving straight up or straight down, they'll tend to move in short-term cycles, in a stair-stepping pattern as they're moving up or down or sideways. And if the trader can identify the stair steps within that pattern, it might give them insight into which way the stock is currently headed. So for example, with Blackstone, if we look at this period, starting back here in December of last year, moving all the way through to the middle of June, all the way into summertime, you can see the stock really wasn't accomplishing much. And what a trend trader might note at that point is the stock was moving through cycles where it would run up for a period and then pull back, completing one cycle. Run up for another period, pull back again, completing another cycle, and on we go. So if we look at this period here we ran up for a couple of weeks and we pulled back for a few weeks. And we ran up for a few more weeks and we pulled back for a few more weeks. Now you'll notice the length of time of these cycles can vary from one to the next. But the identification of the highs and the lows within those cycles can become critical in identifying which way a stock's trend is heading. So I'm going to carry this out to about here. Let's pull this out to August. So you'll notice something as we compare the cyclical highs all the way through June and the cyclical lows all the way through June. They're kind of a mess. Sometimes the highs manage to get a little bit higher. Sometimes they drift a little bit lower. Sometimes the lows manage to get a little bit higher. Sometimes they drift a bit lower. But overall, generally, highs and lows going sideways. During that sort of a time frame, the trend might be identified by this manual sort of approach as being sideways. And for our trend trader, this might just be a time to pump the brakes, to wait for a new trend to develop. Now, what happened here is starting in June, we hit a cyclical low and rose up to a peak and hit a new cyclical low. For a trend trader who applies this sort of manual approach, they might say in hindsight here as we move deeper into July, hey, it looks like we've just accomplished a higher low. If you look at this low June 10th, compare that with a low a month later on July 10th, hey, that's kind of convenient. That's a higher low. So a typical trend trader might look for a confirmation that we've also accomplished a higher cyclical high. A combination of a higher low and a higher high is for some the definition of an upward trend. And so coming off of this high, they might start to think, oh, it looks like Blackstone has finally moved out of this sideways pattern and is starting to move higher. And at this point, they also don't know how much higher and for how much longer might the stock go. They may have a plan, I think I'm going to grab onto this trend, but when do I take profits? We'll discuss that a little bit later. But yeah, you can see that after that pullback, the stock continued to push into higher highs and higher lows. And that really appears to be the case all the way up to the present day. Am I using, yep, I'm using the channel tool. Let me switch up tools here. There we go. Now let's just illustrate those highs and those lows all the way up to where we are right now. Stock pulled up pretty recently, right up to this high here. All right, so for some, that's a perfectly serviceable way to identify a trend if they're comfortable analyzing highs and lows. If that's their preferred approach, they're okay with that manual process, great. For others, though, this sort of a process of identifying highs and lows can carry a lot of psychological pressure, a lot of emotional pressure. I had to make this decision, therefore the responsibility falls entirely on my shoulders. Isn't there a way that this might be automated, made to be a little bit more systematic and also lift some of the emotional burden here? Possibility. So let's look at the second possible way. Now, there are lots of other ways that trends might be identified. I'm just talking about two very common broad approaches. So let's right-click on one of these drawings. I'm going to clear the drawing set. And another approach is to use a technical indicator or a study. So we're going to come right up here to the little flask icon at the top of the charts. And we're going to use a study known as a simple moving average. This is a line that's automatically applied to the chart. We're going to choose this from our menu of potential studies. Click Add Selected, and one customization that the trader might need to settle on is the length of time frame for the study. Now, I'm using daily charts on a 1-year time frame, and for some traders, they might use this study on a very short-term outlook, maybe just over the course of a couple of weeks. Others might want to take into consideration more time, so they might stretch it out to a month or 2 or 3. So I'm going to change this from just a 9-day time frame for the construction of this indicator. Over here to the right, there's a little gear icon that allows us to change that time frame. Let's change the length of our study to, how about we go with 50? I'll explain what that means as we apply the study, but let's click OK, click Apply, and click OK again. And I do want to explain for those who have never seen a moving average before just exactly what we're looking at. So obviously, as I apply that study, we're left with a line that's intended, among other potential applications, to identify a trend of the stock. And a basic interpretation here might be, if this line is going up, then we might consider this to be an upward trend, and we might look for new bullish trades. If the line is going down, maybe we consider it to be a downward trend, and we might be looking for bearish trades. So right now we can see that the line is up. So what does this simple moving average represent? Well, we selected 50. So specifically what we requested from the system is look back over the last 50 days, since this is a daily chart. It's incorporating 50 days worth of data, and give us the average closing price of Blackstone over that 50-day period. So you'll notice there's a number over here to the right, 163.13. What that's doing is just telling us over the last 50 days, about this period that I'm circling, the average price has been 163.13 at the close. And that actually includes today's current price. So over time, though, that value changes. So if we were to look at the same value back here in July when prices were lower, well, you would expect that average closing value to be different. So that 50-day average value changes over time. So we refer to this as a moving average. And it's called a simple moving average because it simply refers to the closing values for the stock. So there we go. That's how this is constructed. And for some traders, they consider it to be possibly a more insightful view into the trend of a stock if we can just see what's happening with the change in average prices over time, rather than just the absolute change in price, from day to day. Like if we get a white candle one day, you get a red candle the next day, it can be very confusing, and it might be difficult to interpret when drawing one's highs and lows. Where do we draw the highs and where do we draw the lows? There's a lot of discretion, a lot of interpretation involved there. This doesn't require discretion or interpretation beyond selecting the time frame at the adding of the indicator to the chart. So we did choose 50 days. If somebody wants to use a shorter term time frame for faster trend changes, we might use a 30-day or a 20 or a 10-day moving average. On the other hand, if a trader is looking for longer term trend indications, they might use a 100-day, a 200-day. Those are just some common moving average data sets, but they certainly can extend beyond that. So there whether we're using a manual approach to trend identification or an automated approach, the first and possibly the most important step for a trend trader in planning their trade is to identify the trend. Because if we're trying to trade bullishly in the face of a persistently bearish trend, that can be tough to do. On the other hand, if we have a persistently bullish stock and we're off with our timing, oops, I should have bought on Friday and I bought on Tuesday, and yet the stock just went way higher anyway. Does it really matter that much? Probably not. The trend, if it's persistent, if the trader can just get on the right side of the trend, that can be a big deal. That can help to erase a lot of the timing issues with the rest of this process. But let's get on with step number 2. And this addresses the fact that even within an established trend, a trader might recognize, boy, it really seems like if I want to latch onto this trend, there could be, conceptually, better or worse times to enter that trend. For some traders, they like to look to get in at lows. For other traders, they want to get in just as we're breaking through recent highs. But all of that leans on a trader's ability to identify what are called support and resistance levels. Let's spell resistance correctly. So support and resistance is simply a trader term that we use for price floors, that's support, price ceilings, that's what resistance means. So as we're starting to run up in our trend here, a trader might wait to see, well, where are recent floors? And one potential floor is just to look as we get closer to the average price. That can sometimes act as a pretty serviceable floor. So if we get well above the average price and we start to pull back, as price pulls back, traders might naturally think, oh, we're getting back down to where I'm not paying well above average. Now I'm getting close to where I can pay at or near average, and that might be a little bit more palatable for a broader spectrum of buyers. It can buy in some buying enthusiasm, possibly cause price to start to rise again. So that's possibly one way to identify a price floor, is to just use our moving average. If we've identified the trend manually, maybe we use a trend line instead. Now, another way to identify price floors and ceilings within an upward trending stock is just to look at previous price floors and ceilings. So for example, here, looks like our stock ran up to a price ceiling right around 143. I'm going to use some nice round numbers just for simplicity's sake. But you can see right through here, our stock ran up to about 143, maybe up to 144, and then pulled back. It ran up to that 143, 144 area again, and it pulled back. So that looks like that was setting up as a price ceiling. When we finally pushed up and through that, you'll notice we came down to within a few dollars of that as a price floor. So we might identify that as an area of support or resistance, an area of price floor or price ceiling. And so if our trader is well above that possible price floor, maybe they wait to get closer down to that before they look to enter. Now, alternately, some might actually just look to enter just as we push up through that price ceiling, but getting better at identifying support and resistance levels can also be key to planning and placing a trend trade. Now, here's what I would suggest. I'm not going to go too much deeper into support and resistance levels than that quick discussion right there. But what you might want to do anytime you have an interest in learning something more about trading or investing, you can just come to our Trader Talks channel on YouTube and do a search, do a keyword search. For example, you might type in resistance and do a search for recent webcasts that spent more time on just that topic, or support and resistance. All right, but let's go back to our chart here. I'm going to leave that drawing on there. And I might also note that that recently price has run up to about, what, 183.5-ish. Might have drawn that a little bit higher. But it looks like over the last week and a half or so, it looks like there's been a price ceiling or a resistance level around that 183.5 level. Well, identifying support and resistance can bring us to the third step of planning. Let's put in number 3 rather than number 4. There we go, our third step in planning and placing a trend trade using charts, and that is to have a specific plan for entries. So this is going to lean on both of the entries that I'm going to discuss today as example entries are going to lean on a trader's ability to identify these support and resistance levels. The first is when we look for a break of resistance. This is interesting because we have that just today on Blackstone. But for some traders, when they've identified trend going in their intended direction, and they've also identified when there's a price ceiling that appears to have set up, the event of a price ceiling breaking, like we saw right here, that can be an exciting event, because let's put ourselves in the shoes of the traders from back in August and September, and as we're about moving into the middle of September here. What they may have noticed here is the stock ran up and it hit that 143 and change level once, twice, 3, 4, 5, 6 times, and then pulled back. And then it ran up there 7, 8, 9, 10, 11 times and pulled back. And a 12th and a 13th time, we're right up there under that 143. It just seems like there's this barrier. Can't seem to break through it, and that can cause hesitation for new entries. Once that barrier is broken, though, we actually refer to this as a breakout entry. And for some, it might mean, hey, we've finally gotten through a barrier. It's kind of like this spring has been coiling tighter and tighter and tighter. Now it's finally popped, and there may be new energy for the stock to move in their new direction. In this case, in a bullish direction, we would refer to this as a bullish resistance breakout. So potential entry number one might be a breakout. Now, for some, it might be perfectly actionable just breaking through that price ceiling, but for others, they like to see additional conviction on the part of buyers. So they may actually look to see if volume also increased on the day of the breakout. So let's add volume to our chart. I'm going to come up here to our little gear icon. This allows us to customize our chart settings. Whether or not volume is displayed is one of our chart settings. So Faz just asked this question, can Thinkorswim draw support and resistance automatically? There are a number of ways that might be done. So I'll say yes, there are indicators that we might recruit. I'm not going to do that for today's discussion, but there are all sorts of potential technical studies that might be applied. You know, things that spring immediately to mind might be like, for example, Bollinger Band, a linear regression line with an envelope. Yeah, there are lots of different ways that we might do that, but for right now, we're just going to rely on our own eyes, and this can require that it takes some time to adjust one's eyes to this sort of a thing. So, for example, historically, there was also a price ceiling, it looks like right around 130. I'm just going to draw this with my oval tool. Right around that area, you can see how price would run up and pull back and run up and pull back and run up and pull back. And we finally broke up and through that. And that may be, for a new trend trader, a time to start to take a new position. So here's our breakout. Let's see if this one, more recently, was accompanied by an increase in volume. And also, what about today? Yeah, today you can see we had that resistance. We had a price ceiling for about 6 trading sessions. And finally, we're pushing up and through that. But if we come back up here to our chart settings, let's go to, this is a stock, it's an equity. So we're going to show the volume subgraph for our equities. Let's click apply and click OK. And let's go back to this one. I'm going to have to zoom in on this one a little bit. So a zoom function on Thinkorswim charts is to just click and drag over a period of time that might be of interest to the trader. Let's say I want to get a closer look at this time from July into September. So I'll click and drag to highlight that, right to left, left to right, it doesn't matter which. And when I release that click, it zooms in on just that period. And what we can see here on the day of this breakout, was a little bit, I would call this a little bit of a mediocre volume increase. Was that a higher volume day? A little bit. Yeah. Where was it? Let's be precise here. Right there. If I draw a horizontal line back, you can see this is one of the highest volume days in the last month. So was it terrible? No. Was it higher volume? Yes. I think for those traders who are looking for an increase in volume, that could be adequate. Might they have been more satisfied with maybe a little bit proportionally stronger move, stronger volume? Possibly, but still above average volume here. As we zoom back out, though, look what we're getting today. Oh, we are now only an hour and a half from the end of trading. And I think our traders might have a little bit of a different opinion. Our volume confirmation traders, there's a few hours, not a few hours, an hour and a half where we might stack up a little bit more volume. This is looking like it's setting up to be a lower volume day. So for those who use that as a qualifier for an entry, they might not consider that to be a quote unquote valid breakout. May not be sufficient conviction. By that, I just mean it doesn't seem to be there's a lot of traders rushing to buy the stock right now. Just lighter volume. All right, so that's interesting. That's one possible entry. Now, a second is not when we're breaking through a resistance level or a price ceiling, but actually when we've come down toward a support area. So we have this area where price got well above our trend line. It got well above our moving average. It also got well above our previous price ceiling, which may act as a new price floor. So the trader might be waiting for a pullback. Well, as a stock pulls back, are they just going to try to catch it like a falling knife? Or might there be a signal here to tell us that the pullback has ended and we're likely to start going back up again? I want to zoom in on this period and talk about a second entry signal known as a bounce. Now, a bounce is sometimes accompanied by an acronym, CAHOLD. How many of you are familiar with CAHOLD, known as a Cahold entry? I'll bet a lot of my attendees are right now. I think this webcast is likely to be seen by hundreds or thousands of people after we're done, and I would suspect a lot of those are not going to be familiar with a Cahold bounce. But here's what we're attempting to address. The stock has run up quite a bit. Our trader is interested in possibly buying it, but they don't necessarily want to buy while we're sitting up here in space at highs, at recent highs. Instead, they're waiting for the stock to pull back to some extent, get closer to support, and then to show some sign that momentum has returned and starting to go back upward again. Maybe the bulls have regained momentum. Ted, you're familiar with this, right? Scott, yeah, you know Cahold, right? Barb, yes, close above the high of the low day. So here's what Barb is referring to. As the stock is pulling back, what some traders will do is focus on the lows of each day. Notice as we're pulling from this red candle to the next red candle, that red candle's little tail stuck down further. It's from day to day, the lowest price is going lower. We went lower again and lower again. This one, yep, a little bit lower. Ooh, this day we did not go lower. We went higher. You'll notice from September 26th to September 27th, on a day-to-day basis, those lows are starting to go higher again. By the definition of an upward trend, there's a piece of an upward trend here on a day-to-day basis. Well, as a confirmation, what some traders will look for is, did the stock then close above the highest price of that, what we call the low day, the day that stuck its tail down the furthest? And I can see from this white candle, nope, we did not close above the high of that low day. Another issue with this being an entry, look how far we're still above our price floor. Oof. For some traders, that might be just too distant. So didn't close above. Now, close above the high of the low day is actually our acronym, our Cahold acronym, close above high of low day. Bit of a mouthful, but it's really just describing a possible return of technical momentum on a chart. So then look what's happening with our lows again. They're going lower. It went a little bit higher here, still didn't get a close above this day. Lower and lower and lower and lower and lower. Ultimately, we wind up with this day right here in this whole series of downward moves from day to day. This candle actually stuck its tail down the furthest. This would now carry the title of the low day. After that, the trader is going to focus their attention on the highest point of that low day and wait for a subsequent day that closes higher than that. So the highest point of this day, if we really want to be precise, we can point at that candle and look up here at the H for the high. So as I pointed that candle, it says the high of that day was 149.50 on the nose. So if we can get a subsequent day where price closes at 149.51, what that might mean is that not only did we get above that high, we closed above that high, and maybe the momentum has shifted. Next day, didn't get it. Where did we close the next day? 149.03. Where did we close the day after that? 153.04, decidedly above 149.50. So this would then be our bounce day, closed above the high of that low day. So we've identified an upward trending stock that's come relatively close to support. It has then bounced for a close above the high of the low day. and the trader is ready to start pushing buttons and enter the trade if this is their typical approach to trend trading. But there's the small problem of, what about the other end of the trade? You ever notice lots of people are willing to say, hey, buy here, not so many people willing to say, sell there? That's where the real accountability comes into play. Isaiah says, what does the slim part of the candle show? So Isaiah, you're talking about just this, the wick of the candle. So the construction of the candle is the vertical height of the candle just draws a line from the high of the day to the low of the day. And then the body of the candle tells us where the open and the close were. If we have a red body, it tells us that the open was the top of the body and we fell during the day, red. If it's a white body, it tells us that the open was the bottom of the box and we rose during the day. So a green or a white candle. There we go. So yeah, that's what this means. Just means this candle got as high as this, it got as low as here. So let's talk about the other end of this trade. The fun part or the not so fun part. For a trend trader, the ultimate objective here is to find what they consider to be the best time to get into a stock and then just ride that stock for as long as they can. But ultimately, the stock is going to start to come down at some point, and that's where they'll have a line drawn in the sand. So it all begins with planning to manage the downside of the trade. Now, this is where there's a distinction between, maybe you've heard of what's called a swing trade. A trend trade and a swing trade are significantly different. And the difference is, with a swing trader, their plan is, I'm going to buy at X price, and then I'm going to sell at a predetermined price level that we call the target. Maybe they've seen a stock that's going back and forth between $40 and $50, so they're going to buy at 40 and sell at 50. Well, with a trend trader, there is no predetermined target. At this point, let's put ourselves in the shoes of our trader back here. I'm gonna zoom in on just this part of the time frame. So here we find ourselves, we're buying the stock, we're hoping it goes up, but we have no idea how far. And we don't want to artificially limit that upside potential. So actually the trader does not place a target, but they do plan for if the stock starts to go down instead of up. So a common method for managing the downside, the initial downside of the trade, is to look for a recent support. And it looks like there's, in this place, a convergence of a couple of technical points. Number one is this old resistance right here at about 143. Number two is a rising moving average is right about the same area, but they might look for just support. So it is leaning on this ability. Can we identify those price floors? And then a stop is placed some distance below that. Now, there can be a temptation in our effort to try to minimize risk to put a very tight stop. I'm just going to put it a penny below that support. Well, there are pros and cons to doing that. If we use comparatively tight stops, what's the pro? Well, it minimizes the conceptual downside risk of the trade. What's the con? Well, we haven't given the trade very much wiggle room. And if the stock just wiggles a bit, if it comes down here and just touches that support, it might trigger our stop, kick us out of the trade, and then the stock just continues going higher. That's what we'd call a whipsaw. We got whipped out of this trade, and then we saw the bus leave. I just made that up. No. But yeah, but it is known as a whipsaw event where we get kicked out of a trade just at the wrong time. And then the stock does what we thought it was going to do. So rather than using quite tight stops on trend trades, trend traders will tend to lean a little bit looser with their stop placement. Now, when we take a larger risk per share, yep, we might need to buy fewer shares as a result. So it can have implications for, the number of shares ultimately purchased. But one common placement is to go 3% below support. I'm not saying that's the only way to do it, but for some, they might see that as giving this enough wiggle room. So if our let's say our support is there around 143, if we multiply that by 0.97, that has the effect of subtracting 3%. Our stop might be placed down here at 138.71, and I want you to see that on the chart and sort of grapple with it psychologically. Let me switch up my drawing tool here. Let's remove this drawing. And let's draw in just a nice horizontal line at 138.71, right? So around here is going to be our stop. Now at this point, does the trader hope it falls down there? Of course not. What they're attempting to do is draw a line in the sand to have a plan in place in case the trade just goes wrong. Despite all of our efforts, despite our efforts to identify trend and where we think support and resistance are, despite looking for that hold bounce entry or possibly a breakout on an earlier trade, is it still possible the stock's just going to have its own mind and go right on down instead of going up like we were hoping? Of course. So if the stock pulls down, the trader has drawn a line in the sand, and that may trigger a stop to get us out of the trade. As I say that, I do want to also mention that just because we put a stop in place with a sell stop order and with other types of stop orders, it's not a guarantee that we're going to exit at a specific price, but at least we've drawn that line in the sand. So all of this is now adding up to having a plan for the initial placement of the trade. All right, so let's say we place the trade. Let's go ahead and do this trade. How about we go to our, actually, let's not do it on this one because I'm thinking historically and then moving mentally ahead to placing a trade. Let's find something that's maybe a little bit more current. How about I look for, I think Boston Scientific had a recent breakout. Yeah, so here we have our stock moving up. It looks like we have a recent resistance that has set up right around $89, right about there. And our price has just popped up and through that level, and you can see actually momentum that seems to be confirmed by higher volume. It's not a guarantee the stock is going to go higher, but for those that use volume as a filter, it was a higher volume day carrying us through this resistance. All right, where might we place our stop here? Well, some trend traders might look at this broken resistance and go 3% below that or some distance below that. Others, though, might actually look down to the lower support level, the trend line itself, and say, well, you know, if we get down below this broken resistance, our trend might still be intact. If we get down below this trend line, maybe now we really have a concern. So what if we were to go, for this example, 3% below our 85.56? Let's go to our calculator. 85.56. Multiply that by 0.97, that would have our stop right at about $83. So let's help to visualize this. Let's put in our stop down here at 83. It's a larger risk per share. That's a pro, that's a con. The potential pro here is we're giving this trade more wiggle room to hopefully realize its potential. All right, so now let's go place this trade. We're going to buy the stock. Looks like it's trading around $90. Stop down around 83. Markets are still open. Let's see if we can get a quick fill. How many shares should the trader buy? It's always up to the trader to calculate what might be appropriate for their portfolio. But let's say our trader is comfortable spending, you know, $9,000. That would be 100 shares. So I'm going to right click on the ask price here and put in a custom buy order with our stop attached. See Bravo says, what about kablowed exits, Cam? That wouldn't necessarily be appropriate for a trend trade discussion. So this is asking about maybe a shorter term exit after just a single move upward. Not typical of a trend trade, I will say. Is a hold entry followed by a kablowed exit? And I know you don't even know what a kablowed is. It closed below the low of the high day. Sorry to get off on a little bit of a tangent here, people. But that would be a shorter term sort of a swing trade approach, not really a trend trade exit. Okay, but let's place our trade here. Let's buy 100 shares, sell 100 shares at a stop of 80, what did we determine? $83, right? I know I'm rounding up a penny from our calculation. That's okay. Good till canceled order here. And I'm actually going to submit this as a market order on the entry. When we submit a market order, there's a risk the order, you know, might fill at a price that we wish we didn't have to pay, but let's click confirm and send, buying 100 shares of BSX, market order, going to sell those with a stop at 83 bucks. That's going to be about a $9,000 trade. No commission on this trade. Just bear in mind that with market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from quotes displayed at order entry. And with stop orders, there's no guarantee the execution price, if our $83 stop order is triggered, it might fill at a price significantly below 83 bucks. No guarantee that the execution price will be equal to or near the activation price. Let's send that order off. All right, so we're in. That leaves us with this one final but possibly essential step in trend trading, and that is stop management. So this is our initial stop. Let's suppose that the stock just takes off, starts making higher highs and higher lows. It's working beautifully, and it goes up to 95 and then pulls down to 93. It goes up to 98 and then pulls down to 95, and it runs up to 110, it pulls down to 105. It's just going higher and higher and higher. Meanwhile, our stop is waiting down here patiently at 83 bucks. What that's doing is, as the stock price goes higher, the risk per share is growing and growing and growing. And don't you think it might make some sense to maybe bring that stop up from time to time if the stock continues? Yes, for trend traders, that's a typical behavior. So what they might do, I'm going to use our BX trade as an example, just so we can look at this sort of historically. Let's suppose that our trader was in on a bounce down here or a breakout right here, and the stock runs up and it pulls back, and maybe their initial stop, maybe it was back down here below this bounce. Stock runs up, it pulls back, starts to rise again. When a subsequent bounce or breakout is recognized, at that point, our trader might decide, hey, I'm going to cancel the original stop and move that up to some distance below the new support. And as the stock runs up and pulls back, maybe it bounces again or it breaks out, the stop might be moved up again. So there is active management of the downside of the trade if the trade moves higher. Now, ultimately what that means, let's say we got this breakout up here, maybe the trader moves their stop up to here, and then the price falls, trade's over. So that is the way that a trend trade would typically end. It ends after the stock has fallen to some extent. We have to be prepared for that. A trend trade is not designed to get us out at absolute highs. It's actually designed to get out after a pullback below support or below a broken resistance level. There we go. So yes, stop management is something the trader might need to practice. Looking for subsequent highs and lows after the entry and moving that stop up as we see fit. All right. Well, guys, we've actually accomplished what we set out to do today. I said we're going to be outlining a 5-step process as sort of a beginner's guide to trading using or to trend trading using stock charts, and we've done just that. Illustrated it with current examples. Hope you enjoy these kinds of discussions. I really enjoy these Tuesday afternoon webcasts. I hope you put it in your calendar to join me again next Tuesday. Go enjoy the rest of our webcast, but as you go, there are a couple of other resources I want to make sure that everybody's taking advantage of. Number one is make sure that you're subscribed to our Trader Talks channel. You can pop down, click on the subscribe button right now. It doesn't cost anything. It literally only takes a second. But the YouTube channel is the best place to find our playlists of previous webcasts. It's also, you can join our live streams right here. Also, another resource is to make sure that you're following Barb and me and your other favorite presenters on X. You can find Barb on X at Barb Armstrong CS. You can find me here at Cameron May CS. It is really the best place to connect with your favorite presenters, maybe get their thoughts on market developments, or like I just decided to give Kevin Horner a shout out for the fabulous job that he's doing in his Trader Talk in today's market. His daily webcast series is so good. Yeah, so you might want to check that out. But finally, thank you everybody for all of you who've already clicked that like button. We have over 100 people watching the live stream right now. 39 people have already clicked the thumbs up. Thank you for doing that. Whether you're watching live or you're watching on the archive, if you do us all this favor, every time you enjoy one of our webcasts, make sure that you click the like button before you go, because it sounds like applause to your presenter. It definitely is appreciated in that way. It also gives the presenter's webcast a boost in the YouTube algorithm and helps us find a wider audience for these webcast offerings. So thanks, everybody. Go enjoy the rest of our webcasts. Up next, we have Exploring Thinkorswim with Brent Moores. You all know how fabulous he is, so go enjoy Brent. I will see you next Tuesday. I'll also look for you in my other webcast series between now and then. I'll look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.